Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Colgate-Palmolive is one of the world's most recognized consumer goods companies, primarily built around the Colgate brand, which holds the #1 toothpaste position in most global markets.
The company dates back to 1806, when William Colgate opened a starch, soap, and candle business in New York City. 2 centuries of compounding later, it's a global consumer staples giant operating in over 200 countries.
The business has 2 major segments. Oral, personal, and home care accounts for about 80% of revenue, covering Colgate toothpaste, Palmolive, Irish Spring, and similar household brands worldwide.
Hill's Pet Nutrition makes up the remaining 20% and is now the company's fastest growing and highest margin segment. A premium pet food business built on veterinarian recommendations and clinical credibility.
The Colgate brand's global footprint is the core competitive moat. It's not just name recognition, it's deep retail shelf placement, regulatory approvals across hundreds of markets, and decades of consumer trust built through dentist endorsements.
Emerging markets are crucial to this story. More than 70% of revenue comes from outside the United States, including massive positions across Latin America, Asia, and Africa, where Colgate often has category-leading share.
Hill's sits in the premium tier of pet nutrition, competing primarily on veterinary authority rather than price. Its science diet and prescription diet lines are recommended by vets globally, creating powerful clinical lock-in.
The financial profile is characteristic of a defensive compounder. Gross margins run near 57%, organic growth has been running around 8%, and the Hills segment is driving accelerating margin recovery.
The dividend record is extraordinary. 60-plus consecutive annual increases qualifies Colgate-Palmolive as a dividend king, one of the most exclusive groups in the entire S&P 500.
Competitively, Procter & Gamble is the closest peer, larger and more diversified. Church & Dwight and Unilever also compete across categories. Colgate's edge is oral care focus and Hill's premium pet positioning.
Noel Wallace has been CEO since 2019, having risen through Colgate's regional leadership ranks over 3 decades. His focus has been on premiumization, Hill's investment, and restoring operating margins to historical norms.
The global reach is genuinely remarkable. The Colgate brand sells in over 200 countries and territories. Hill's operates in more than 95, and the distribution infrastructure took generations to build.
Key threads: Hill's margin and volume trajectory, pricing durability in emerging markets as consumer spending evolves, and whether Colgate can sustain its premium positioning against private label oral care competition.
Colgate-Palmolive is a classic slow and steady compounder, not a headline grabber, but a business that generates consistent cash flow, grows its dividend reliably, and holds formidable global brand positions.
That's the company chapter for Colgate-Palmolive. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Colgate-Palmolive delivered a beat amid a tariff storm. Q1 2026, EPS of 0.97 versus estimates of 0.94, a 3.2% beat. Revenue grew 8.4% to $5.32 billion. Latin America was the standout, with 18% organic growth. Dividend raised for the 63rd consecutive year. This is Charged Alpha. Let's break it down.
Colgate-Palmolive is a global consumer staples giant, market cap of $70.8 billion. The brand portfolio spans toothpaste and toothbrushes, soap, deodorant, dish soap, and Hill's Pet Nutrition, one of the fastest-growing and highest-margin businesses in the portfolio. Products are sold in more than 200 markets worldwide.
The story in Q1 was pricing power overcoming volume pressure. Organic growth came in at 8%, driven by 6 points of pricing and 2 points of volume. North America volume was negative 3% despite pricing gains, a reflection of consumer trade-down pressure as tariff cost increases flow through shelf prices. The pricing power is real, but it's hitting volume.
Let's walk the income statement. Revenue of $5.32 billion grew 8.4% reported and 8% organic. Hill's Pet Nutrition delivered double-digit organic growth again. This segment is the margin and growth engine of the portfolio. Oral Care, Colgate's largest segment, delivered mid-single-digit organic growth on the back of premium toothpaste SKU expansion.
On margins, gross margin pressure was the key concern in Q1. The company cited raw material inflation, logistics costs, and tariff-related input cost headwinds as gross margin compression drivers. Full-year gross margin guidance was lowered, signaling management does not expect a rapid relief in cost pressures. Operating margin held through SG&A discipline, but the gross margin trend is a watch item.
Cash flow and balance sheet. Operating cash flow for the trailing 12 months is $1.8 billion. Cash of $1.3 billion against total debt of $8.4 billion results in net debt of $7.1 billion, a leveraged balance sheet for a consumer staples company, but manageable given the reliable free cash flow profile.
The 63rd consecutive annual dividend increase is the Dividend King achievement, a status held by fewer than 30 public companies. The increase signals management's commitment to capital returns even through tariff headwinds. For income investors, Colgate's dividend durability is the primary investment thesis.
Tariff impact is the biggest near-term risk. Management estimated approximately $300 million in tariff headwinds for full year 2026. The company is attempting to offset this through pricing, but pricing has already driven North America volume negative. The ability to fully pass through tariff costs without further volume deterioration is the key question for the second half.
Wall Street consensus, 13 buy ratings, 6 holds, 1 sell. Average price target of 95.50 implies roughly 10% upside from current levels. The buy camp believes tariff headwinds are temporary and that Latin America growth and Hill's momentum justify the stock at current prices. The holds are watching for gross margin stabilization before upgrading.
Valuation. Colgate trades at approximately 26 times trailing earnings and 22 times forward 2026 estimates. EV to EBITDA is in the 17 times range. Price to sales is 4.7. For a stable growth consumer staples brand with Dividend King status, the valuation is fair but not cheap, particularly given the gross margin headwinds that compress near-term earnings.
HSBC recently upgraded to buy, citing Latin America as an underappreciated growth driver. The 18% organic growth in the region reflects pricing power in inflation-prone economies, where Colgate's local currency contracts allow continuous price adjustments. Analysts at Citi maintained neutral, arguing gross margin guidance cuts offset the top-line beat.
Bears point to the North America volume trend. Minus 3% volume growth means consumers are responding to pricing with trade down. If private label penetration accelerates, Colgate faces a structural mix shift away from premium SKUs that undermines the pricing strategy. Tariff-driven inflation is temporary. Brand erosion from trade down is structural.
Beta is 0.52, defensive in market downturns. Forward EPS for 2026 is 3.83. At 22 times forward estimates, Colgate is priced for steady mid-single-digit EPS growth. Missing that growth target by 2 to 3 points, which tariff headwinds could cause, would result in meaningful multiple compression.
The bull case rests on 3 pillars. First, Latin America organic growth. 18% organic revenue in a high inflation environment demonstrates real pricing power. As LATAM inflation moderates, volume recovers, and Colgate retains the pricing gains, a pattern from prior EM inflation cycles.
Second, Hill's Pet Nutrition. Premium pet food is one of the most durable secular growth categories in consumer staples. Pet humanization drives premiumization. Hill's Science Diet and Hill's Prescription Diet have vet recommendation advantages that create sticky purchasing behavior and limit price sensitivity.
Third, 63 years of dividend growth. The consistency signals pricing power durability through multiple economic cycles. Colgate has navigated oil shocks, recessions, and prior tariff regimes while maintaining its dividend growth streak. Bulls argue this cycle is no different.
The bear case, tariff headwinds of $300 million represent roughly 8% of operating income. If pricing offsets fail to hold volume, The revenue minus volume spiral compresses both top line and margin simultaneously, a double hit that would pressure EPS below the current consensus estimate.
Second, gross margin guidance cut. Management explicitly lowered the gross margin outlook for the year. Gross margin pressure in consumer staples is the most reliable earnings risk signal. It tends to be persistent because raw material and logistics contracts extend over multi-quarter periods.
Third, North America competitive pressure. Procter & Gamble, Church & Dwight, and private label all compete for the same shelf space. With consumers price sensitive, any Colgate price increase creates an opportunity for competitors to gain units.
The consumer staples peer group includes Procter & Gamble, PG, market cap over $300 billion, Kimberly-Clark, KMB, market cap $70 billion, and Church & Dwight, CHD, our next episode. Versus PG, Colgate has more emerging market exposure, and Hill's as a unique pet nutrition asset. Versus KMB, Colgate has better brand pricing power and broader international reach.
Options activity around Q1 was balanced. Put-call ratio of 1.12 reflects near-equal call and put interest, consistent with a defensive consumer staples name navigating a macro cross-current. Income investors are selling covered calls at the 93 to 95 strike range. Hedgers are buying puts on tariff uncertainty.
Insider activity shows modest selling at recent highs, management acknowledging elevated valuation after a period of outperformance. No sales in the last month. Vanguard and BlackRock are top institutional holders at 6 to 8% each.
Bottom line on Colgate, a dividend king navigating a tariff headwind with pricing power and Latin America growth as its anchors. The EPS beat was modest, 3%, and the gross margin guidance cut is the key concern. Long-term holders stay for the yield and the brand durability. New buyers should wait for gross margin stabilization signals before adding.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.